Welcome back to Alpha Recap, your weekly rundown of the market moves and research highlights. Markets closed after the bell, and we've got a lot to dig through. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. So much happened this week across AI, buybacks, and some big earnings beats. I mean, when you step back and look at this, it really felt like a story about who's capturing the AI tailwind and who's still figuring it out.
Totally. Quick overview before we jump in. The recurring themes in the research were AI as a cross-sector growth driver, heavy corporate buyback activity, and a pretty stark divergence in valuation between leaders and recovery names.
Right, and information gaps showed up too. A reminder that missing disclosures can change how analysts think about a company.
Let's start with the big AI names and market leaders. NVIDIA got a lot of attention. Analysts noted an earnings per share beat for the quarter and continued triple-digit rolling revenue growth in AI compute. They framed NVIDIA as the primary beneficiary of the AI infrastructure build-out, but also flagged demand cycles and competition as downside risks.
Yeah, that tracks.
And on the healthcare side, Lilly grabbed headlines with positive Phase 3 data for its obesity candidate, retatrutide. Analysts called Lilly more of a double growth story now, diabetes plus obesity upside, while cautioning that competitor and payer dynamics could pressure the long-term story.
Honestly, I was a bit surprised by this one. Retatrutide's success pushed a lot of optimism. But analysts were careful to remind listeners that premium valuation leaves little room for execution slip-ups.
Let's put some numbers on that. Lilly was trading at about $1,065 a share as of the research cut, with a trailing price-to-earnings ratio near 40. Analysts described the stance as bullish overall, but also noted the competitive landscape with other GLP-1 players.
Switching to communications and software, Twilio had a standout week. The company beat in the quarter, got placed in Gartner's Magic Quadrant for 2026, and analysts upgraded the name. The trailing price-to-earnings ratio was reported as around 274 in the research.
The number that really caught our eye there was the P/E near 274, which is a lot. Analysts are bullish on Twilio because it sits at the intersection of communications and AI engagement, but they said continued margin conversion and improved net revenue retention are needed to justify that premium.
Big move.
Bill Holdings, we'll call it Bill for short, had a notable week too. The company reported an earnings beat and authorized about $1.0 billion for buybacks. Analysts were constructive, citing AI product launches and cost rationalization to boost margins. But they emphasized the need for sustainable monetization rather than relying solely on buybacks as a price support.
Right. Buybacks showed up elsewhere as well. Globon announced about $125 million in repurchase authorization, which prompted a debate in the notes about buybacks as signaling versus buybacks masking structural issues.
For Globant, the research highlighted a classic tension: a buyback alongside middling profitability, an EPS miss, and a pending securities class action. Analysts said the balance sheet strength and AI service push give a plausible medium-term runway, but near-term risk is elevated until results and legal clarity improve.
Not what anyone expected.
Splunk was an outlier for a different reason. The research team noted missing key financial metrics in their dataset. Market cap and price to earnings were unavailable, so coverage took a neutral stance. The broader point was methodological. Absence of data is itself an insight and should temper conviction.
So, what really stands out here is that silence can be loud. If you don't have the numbers, it's hard to make a strong call either way.
Exactly. Okta was another interesting case. Okta was recovering from April lows and trading at about $92 as of the note. Analysts called the stance neutral. The company benefits from identity leadership and AI monetization potential, but upcoming first quarter fiscal 2027 results were flagged as a near-term test for growth and customer metrics.
DocuSign showed AI product momentum around agreement workflows, but research pointed out slower than historical revenue growth and tighter liquidity. It was another neutral stance. Product innovation could be the catalyst, but clear top-line momentum is needed.
Surgical robotics also came up. Intuitive Surgical and its Da Vinci platform are getting upgrades. The DaVinci 5 program was highlighted as something that could deepen the installed base and drive instrument and consumable attachment revenue. But remember, Intuitive was trading with a price-to-earnings ratio north of 50. So analysts warned that valuation leaves less room for error.
And then Danaher. Analysts liked the mix there. Strong first quarter beats, raised guidance, and 7% core biotech revenue growth. Plus AI tools for CMC and even a carbon capture pilot. The research suggested the recent pullback made the risk-reward more interesting, despite a quality premium.
Okay, time for the connective tissue. The patterns the analysts kept calling out across the notes. First, AI as a demand amplifier. From semiconductors like NVIDIA to enterprise software names and life sciences tools, AI was repeatedly cited as a driver of pricing power, feature monetization, and incremental total addressable market.
Right, but the caveat was consistent. AI creates opportunity, but capture depends on scalable software layers, recurring revenue models, and proprietary moats. If you don't have that, AI can just be hype.
Second theme, buybacks as an active signal. Bill's $1.0 billion and Globant's $125 million programs were explicit examples. Analysts view buybacks as stabilizing, but the impact depends on buyback size relative to market cap and free cash flow.
Right. Buybacks matter more when they come with improving operating metrics. A buyback plus an earnings beat is a different story than a buyback hiding weak growth.
Third pattern, valuation bifurcation. Leaders with clear AI or therapeutic optionality, NVIDIA, Lilly, Twilio, were trading at premium multiples. Recovery stories and names with disclosure or legal overhang, Globant, Splunk, DocuSign, were at materially lower multiples following pullbacks.
Yeah, the gap was pretty wide. Analysts said that premium multiples are okay if execution is consistent, but anything less than steady execution raises downside risk.
Fourth, event-driven near-term catalysts dominated conviction. Earnings calls, product launches like the DaVinci 5, and clinical milestones such as Lilly's Phase 3 readout were singled out as immediate drivers of repricing.
Which connects to their research agenda. Next week, they plan to focus on Okta's quarter, DocuSign's June earnings, buyback execution details at Bill and Globant, and cloud provider commentary to gauge NVIDIA demand.
Methodology notes were useful too. Analysts leaned on trailing and forward price to earnings, PEG ratios, net revenue retention, ARR growth, churn, and margin conversion for software names. For hardware and consumables, they looked at procedure volumes, installed base monetization, and recurring consumable revenue.
Data quality mattered. The Splunk note basically said, when core inputs are missing, default to neutrality rather than guessing. That's a good reminder for listeners who follow coverage across names.
Let's pull a few quick company takeaways so listeners can remember the headlines. NVIDIA, primary AI infrastructure beneficiary. Strong numbers, but exposed to demand cycles. Lilly, Phase 3 win, a doubled growth narrative, but premium valuation and payer risk. Twilio, momentum and high expectations, needs margin conversion. Bill, earnings beat and a large buyback, constructive if monetization sticks.
Globant, buyback plus legal overhang, a contrarian recovery candidate with elevated near-term risk. Splunk, neutral because of missing metrics. Okta and DocuSign, product and AI optionality, but near-term earnings will matter.
One more quick group summary. Danaher combines recurring life sciences revenue and pockets of higher growth. Intuitive Surgical's upgrade cycle could drive consumable revenue, but valuation sensitivity remains high.
So, what really stands out here is how tightly conviction is linked to execution and disclosure. The narrative alone isn't enough.
Exactly. Analysts gave some contrarian takes too. For example, Globant was framed as a recovery candidate because of the buyback, but research cautioned that buybacks aren't a substitute for revenue or earnings growth.
And Splunk's absence of data was treated as a signal that silence should dampen conviction until the company clarifies.
Let's translate this into practical, non-prescriptive implications. First, focus on execution signals. For high multiple names, analysts emphasized margin conversion and consistent net revenue retention. For biotech and devices, look for durable commercial uptake and payer acceptance.
Second, treat buybacks as a secondary signal. They can be constructive, but only when backed by free cash flow and improving operations.
Third, monitor information flow. Missing disclosures or upcoming earnings should prompt reassessments post-release, rather than speculative extrapolation.
Fourth, run valuation sensitivity scenarios for premium names. Analysts suggested modeling demand durability and regulatory or competitive shocks to understand downside.
Before we wrap, a few short reactions. Quick hits from the research desk that caught our eyes.
Big move.
Not what anyone expected.
Yeah, that tracks.
All right, final takeaways. 1. AI continued to shape cross-sector narratives, but capture requires a business model that supports monetization. 2. Buybacks have become an important signal, but context matters. Size relative to market cap and alignment with cash flow are key. 3. Valuation dispersion is wide. Market leaders trade at premiums that require steady execution. 4. Short-term catalysts, earnings, product launches, clinical readouts, and legal filings will drive next week reassessments.
And just to repeat the research desk's tone, these are analytical observations, not investment recommendations. Analysts note, data suggests, momentum indicates, but individuals should do their own due diligence.
If you want a quick reference, the team offered to put together a one-page dashboard with net revenue retention, buyback size as a % of market cap, and upcoming event dates. That could be handy for comparing AI and healthcare names side by side.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back next week after the market closes with more research highlights and what the numbers mean. See you then!